Hi, you are watching Economy by Bhushan Jalali, a subset of Nancy Foundation. Today we have chosen the topic national income. So, what is national income? Normally we called it gross domestic product, we called it gross national product. What is the difference between the two? This we will be studying today. So, to start with, let us discuss about the gross domestic product, which we generally call GDP. What is the GDP? GDP is the final monetary value of the goods and services produced in a country within the borders in a particular period of a time, normally a year. So, one thing is important, as friends must noted, that the final value of goods and services produced within the borders of our country. It may be produced by Indians, Indian companies, Indian firms, or foreigners in doing business in India, working in India. That their output will also be included in the gross domestic product. So the punchline is that whatever is produced within the borders of our economy, those final value of those goods and services is called gross domestic product. Fine. Then the point is, why we measure, why we have, every country has this gross domestic product. It has two purposes. One purpose is for the purpose of knowing the performance of the economy of the country. That is one utility of GDP. Second is, it is the measuring rod for the purpose of comparison, for the purpose of analysis, for the purpose of planning. For example, if I have to see how much amount a country spends on education, how much a state spends on health, it is normally and it is better to know in terms of the GDP of that country. Suppose country A spends 6% on education, 6% of the GDP on education. So the total GDP, out of it, how much percentage they spend on education? Or we can say, what is the percentage of amount spent on education vis-a-vis percentage spent previous year or some past period. So the purpose of this GDP is for the purpose of comparison, for the purpose of assessment. So GDP has two important uses. One is to know the performance of the economy of a country, and second is a measuring tool for the comparison, for the analysis, for the planning of an economy. Fine, this is what is GDP. Now, what are the methods used for measuring GDP? There are three methods by which the GDP is measured. Number one, the most important, is expenditure method. In a layman's language, expenditure method is the amount spent by every entity in a country. The sum total of that is GDP. जितना पैसा खर्च करोगे वही पैसा तो कोई कमाएगा ना. दैट मीन टोटल इनकम, हमारा टोटल वैल्यू ऑफ गुड्स एंड सर्विसेज वही होगा. This is one way of measuring GDP. That is I again say, it is the sum total of the amount spent by individuals as well as entities. Entities means any business firm, partnership firm, corporate, company, this government, all these are called entities. But to put it as in a formula, we say GDP as per expenditure method is C plus I plus G plus net of exports and imports. What does C stand for? C stands for consumption. We call it private final consumption expenditure. That is, people like you and me, we spent on domestic household goods, we spent on education, we spent on health, we spent on doing all comforts, transport, and anything. So total amount spent by people like you and me, that is called C, consumption. Very important. So we also sometimes mention it as private final consumption expenditure. So C stands for that. Then comes I. I stands for investment. What does investment mean? The businesses in the country, it may be a proprietary concern, it may be a partnership concern, it may be some company, corporate, non-corporate, anyone who does some activity, some business. He invests in plant and machinery, he invests in stocks. That is called investment. Then comes G. G is the amount spent by government expenditures. Government spends on roads, buildings, schools, colleges. Sometimes they also invest in, spend on these private sector undertakings. Normally, government spends on social infrastructure, social facilities. Then comes exports minus imports. Total exports of a country, that is deducted by imports. If you have more imports than exports, then the figure will be minus, in negative. If you have more exports than the imports, then the figure will be in positive. So all these four items are clubbed, it gives you the GDP as per expenditure method. Fine. This is very important for the purpose of analyzing economy. In subsequent chapters, we will be discussing about relevance of these C for the purpose of government's planning, for the purpose of analyzing what are the drawbacks or what steps we should need to improve our economy. So please remember, calculation of GDP by expenditure method is GDP is equal to C plus I plus G plus exports minus imports. Fine. Then second method is output method. What is output method? It is the final value of goods and services produced and that is made available to the consumers. The final value of goods and services. Sum total of those is called the GDP as per production method, as per output method. Nowadays this is calculated in a different way. We call that value added method. What is value added method? Value added method is the amount of, suppose when some object, some product is prepared, it passes through different hands or through different companies. In one company it is being processed to some extent, then it is sold to another company as an intermediary good. Then they also do some value addition, they put some more value addition to it. Ultimately it is sold to the consumer. For example, I give an example of, say, mobile phones. Mobile phones, India imports certain components of the mobile set. Then they add local manufactured some other components. Then they add screens to it. Then they add keypads to it. Then they add microphones to it. So if a good has been imported or produced initially at, say, rupees 100, then you have added some more items and it has become 150. That means 50 rupees is the value addition. So if you have imported it 100 rupees, so that 100 will not be included in the value of goods and services. Only it will depend on the how much amount of value addition has been done in India. That is called value addition. So calculating how much value addition has been done in India within the borders of our geography, the sum total of all these value additions is also called GDP. That is by value added method. This is nowadays this is very common, especially when you want to analyze, you want to assess the performance, the situation in a particular region, particular sector. Then you do only value added method. Fine. Then we have income method. It is measured by adding the total income earned by the factors of production. Now the point is, what is factors of production? As we have read in class 9th or 10th, land, labor, capital and organization, all these form factors of production. Whatever, if you want to produce anything in the country, you have to use all of these or some of these factors of production. That is land, labor, capital. Capital means money, initial money or technology, and the organization. Organization means your entrepreneurship, your management, your skill. These all factors, the income earned by these factors, the sum total of that gives you the GDP by income method. So in this case, we should remember that in the case of land, we call that rent. In the case of labor, we call that wages or salaries. And in the case of this capital, we call its interest. And for entrepreneurship or organization, we call profits. When we add up these all four items, then we get the GDP at income method. Fine. These are the three methods by which GDP of a country is measured. Now we must understand that there are other 2 points in the national income, or we can say GDP. One is costs and prices, and the third point is base year. Suppose when I say it is the final value of the goods and services produced in a country, suppose I say we have produced 100 cars in this year. How do you compute the value of this 100 cars? One system is to take the value, only that value into consideration which has been spent on making the car. That is called at factor's cost. The inputs, the amount of total amount spent while preparing, constructing, building, manufacturing a car. That final value is taken the unit value of the car. We call that the factory cost. We call that as a factor cost. So when you calculate GDP using this funda, then you call that GDP at factor cost. Fine. Second is when you sell the same car to the purchaser, it has some more value, more price, more costs added to it. Which costs? One is taxes, indirect taxes, and there is some amount of subsidies also involved in it. Then the net value of that gives you the cost of the car. When you take that into consideration, on the basis of that funda, then you say that it is the GDP at market price. Fine. So whenever you say what is the GDP of a country, as a student of economy, take care that what this value is. Is it at factory cost or is it market price? So as an economy student, you must be particular about knowing this. ऐसे तो उसने कह दिया GDP इतना है, but you try to read it, go deep. What is the modus operandi for calculation of this GDP? So one is at factor cost, second is at market price. So this is one more aspect of the national income. Another point in this national income is which prices. Are you taking into consideration the prices as on date or on some previous date? Normally, as on date, the policy of the government is that we take, for the purpose of calculation of GDP or inflation, we take the prices as on 2011-2012. That is called the base year. So GDP is calculated, computed both at base year prices as well as the current year prices. When you mention the GDP at base year prices, they are called GDP at constant prices. They are also called real GDP. When you take into consideration the prices prevailing at as on date, those prices are called GDP at current prices, or we also say GDP at nominal prices. Am I clear? So you should be conscious about whether this is a GDP, real GDP, or GDP at constant prices. That is one and the same thing. Or it is at GDP current prices, or GDP at current prices is also called nominal GDP, GDP at nominal prices. So these things we have to take into consideration while reading or understanding the GDP. Fine. This is all about the GDP. Now what is the difference between GDP at constant prices and GDP at current prices? The difference is the amount of inflation. Suppose 2 years back, India produced 100 cars, and cost of one car was 1 lakh rupees. Okay, or we say 10 cars produced in India 5 years back, the cost of one car was 1 lakh. So that means 10 lakh was the total cost of the cars produced in a economy 2 years back. Today India produces say only lesser cars, but the value is more. So that means actually there is no GDP. The number of cars produced is less as compared to 2 years back, but because of the inflation, the price of the cars has gone up. So when you multiply it, it has become more value. So when you see what is the difference between GDP at constant prices and GDP at current price, nominal prices, we see it is because of the inflation. So we must be conscious about reading GDP at constant prices and GDP at nominal prices, current prices. Fine. Now point is why so? Because it is the policy of the government, especially in India. India always calculates GDP at base year, which is currently 2011-2012. Base year with the market prices prevailing at the time of in base year. It is the current policy of the government. So because to take care of the inflation, sometimes the value of the inflation is good, so it gives a false proportion of GDP. To check that impact of inflation, government always considers real GDP for the purpose of planning. So this is all about GDP, gross domestic product. Now we have also net domestic product. Domestic. When you subtract depreciation from this gross domestic product, you get net domestic product. So this is all about GDP. Now we have one more, that is called gross national product. So the difference between gross domestic product and gross national product is that in the case of GDP, only the goods and services produced within the borders of country is taken into consideration, while in the case of gross national product, the income earned out from outside the country is also clubbed with the GDP, then it gives your gross national product. That means it is both quantity wise and quality wise better than GDP. Fine. Now what are the profits, what are the incomes earned abroad? It comes interest on your whatever country may have extended some loans to foreign companies, foreign countries, you are getting interest from that. That is your income. Or the remittances by our non-resident Indians who are working abroad, whatever they send to our country, they are added to our GDP. That becomes gross national product. Only thing we should take care that the borrowing from abroad is not included in the gross national product. So the income from abroad, when added to gross domestic product, it becomes a gross national product. So accordingly, when you deduct depreciation from it, it becomes net national product, NNP. This NNP, net national product, when divided by the number of population in the country, it gives you per capita income of the country. So this is the real, when you talk about the national income. If you strictly say what is national income, it is the net national income divided by number of citizens, that gives the per capita income of our country. That is the national income of the country. So national income is GDP plus income earned abroad. Fine. Am I clear? This national income is written on capital N and capital I. GDP we never write with capital N and capital I. We write GDP, but if you have to mention national income, you can write NI. NI stands for net national income. So fine, these are the gross domestic product. This is net national product. Then whenever you gross domestic product when subtracted from by depreciation gives your net domestic product or net national product. One thing is very important, we should know the role of depreciation. In many countries, the role of depreciation is a tool of economic adjustment. It gives you the rate at which your goods obsolescence take place. That means if you purchase a car, if you purchase a tractor, if you purchase a laptop, as per the policy of the government, they declare what will be its life. In some instruments, some cases they say 3 years, in some cases it says 7 years, in some cases it says 9 years. So the policies may change according to the needs and policy decisions of the government. These rates of change in depreciation sometimes becomes a very important tool for economic development. For example, I give you an answer. I give you an example. Just few years back, government wanted that people should purchase more and more electric vehicles. And the biggest consumer for the vehicle is government departments itself. For a government department, if you want to purchase new vehicle, you cannot purchase unless its life has exhausted. Life means if it has a 7 years 7 years span, you cannot purchase a new vehicle before that period is exhausted. So, in order to boost the purchase of electric vehicles, government enhanced the depreciation rate. That means if they prescribed that a private car or a private bus will be exhausted within, they reduced the from 7 years to 5 years, which compelled the departments to go in for purchase of new cars, which was made conditional that it should be purchased only electric vehicles. So to boost the purchase of electric vehicles, government adjusted the depreciation rate. So depreciation is an important tool in the case of bookkeeping. Those persons who are studying economics and bookkeeping extra, they must be knowing it. So for aspirants, depreciation is an important tool for running the economic policies of the country. So this is all I had to share about the national income. So one thing we should note that I have presented it in a way so that you understand the concept behind how the national income, how the GDP is measured. But this is presented in a slightly difficult way. For example, I say what is GDP? GDP is equal to GDP at factor cost plus indirect taxes or plus taxes, that is whatever GST they have to pay, minus subsidies. Why? Because whatever inputs they have used while manufacturing of that product, they may have got those inputs as a subsidized rates. So that subsidy that should be taken into calculation. Plus whatever it is at factor cost, that means whatever the actual cost incurred on manufacturing. So that on that they put then government charges GST or any tax. So we can present GDP is equal to GDP at factor cost plus indirect taxes or taxes minus subsidies. Same way we also say GDP at nominal prices. GDP at nominal prices is equal to GDP at real GDP or GDP at constant prices plus inflation. So these things you must read, and while doing these practice questions, things will be more clear to it. Otherwise, for the purpose of academics, you must be aware that in the world, United States is the country which has the highest GDP in the world, followed by China, then Germany, then Japan, India, United Kingdom. Again, say IMF, International Monetary Fund, it calculates GDP at purchasing power parity. What does that mean? Purchasing power parity, what does it mean? It means, suppose if I consume 2 eggs a day, they say in India a person consumes 2 eggs. In USA a person also consumes 2 eggs. In USA the cost of 2 eggs may be $5, and in India the cost of 2 eggs is 15 rupees. But in USA it is $5, means near about 400 rupees. So when you compute Indian GDP vis-a-vis USA currency. That means India produces 400 rupees equivalent of X. When you compute those value of goods as per international prices, that prices is called purchasing power parity. It is as per that purchasing power parity, India ranks third largest economy in the world. Otherwise, we are ranking as fifth largest economy. Soon going to become fourth and third. Sometimes fourth, sometimes third. ये बीच change हो रहा है. But as per purchasing power parity, we rank at third. Fine. So far as this base year is concerned, base year I will be talking in some next session. For so far as national income is concerned, I have covered all these things. If you have any doubts, please do not hesitate to send me a voice message or text me or email me. My full details, particulars are available at website www.nancyfoundation.in. Please share it, subscribe it and like it. Thank you.